Hi everyone, hope everybody is doing good. This is Murli again, and I will be sharing my opinion and just trying to put across my points on Unit 4 export financing and international payments, which would be starting with the different types of export finance and the international payments. So, in this session, we would discuss about this, and I would try to give you the modes of payments and the advantages and disadvantages of these mode of payments. So let us discuss the different types of export finance are as follows. There will be the pre-shipment finance and the post-shipment finance, which will be like 118 days and 118 days, 217 days, depending on the size of the business and the type of the business that you're doing and the shipment. Along with that, the export commercials against the collection of bills, then the deferred export finance, and export finance against allowances and subsidies. Starting with the pre shipment finance, which would provide when the exporter or seller want the payment even before the shipment of the products or goods, and the finance is provided for the purchase of raw materials or the products or goods, processing them into finished products, storage, the storage expenses, and the packaging and marking of goods prior to the shipment. Then the third point would be this type of finance is approved when an organization or a manufacturing or a company which builds and try to export these goods also. When such a firm is in order to replace or uh, importer, say for example, importer has its own shipment agent over here and wants a finance for it or sort of insurance. Later we would discuss deeper in this. And the fourth point would be, which is also known as packing credit. Then you have a pre-shipment finance granted for a period of 180 days, which is a working capital to start it from how to pack it, how to ship it, whether you have the buyer ready or not, these things. In the case of off screen or unforeseen circumstances, it can be extended to 90 days, the maximum period allowable in 270 days. So once we've seen this, let us look at this picture so that you will have an idea or a concept how it works. First thing is you have exporter and an importer. Exporter is also called as a seller, and the importer is also known as a buyer or somebody who purchases your products or your goods. So exporter wants to sell it to importer. So meanwhile, there are many circumstances which arise and makes the exporter to take certain help from the government or a financial agent or an individual or a government funded, or there are many banks. For example, Exim Bank, which we discuss in detail in a particular session dedicated to only Exim Bank. And similar to Exim banks, what are the banks are exist? existed in across the country. Exim Bank is a export and import bank of India. So similar to that, you will have banks which work closely or which work under the Industry and Commerce Ministry of any country. So exporter wants to sell it, maybe for an insurance, or he doesn't have sort of money to pay off to the agents or distributor. Certain times the agents have to, or shipping agents and other distributors, they will they will take your, I mean, goods and store it in some way. At times you have to bear the expenses of the storing, uh, keeping it in a place or a godown which will be compliant to the products that you're selling. So for all this process, the company needs, or an exporter needs, money which will be huge. So he cannot put his money at certain times. Most of the times they take financial help from this. So let's get back to the types of business, the types of like we discussed, pre-shipment finance from 180 days to 270 days, so that by the time you store it and find a buyer over there in the other part of the world, so you'll have these many days. Then the post shipment finance is after dispatching the goods to the importer. In the sense, you have already given away your products to the importer. He's already received it, and the importer has to make a bill which is to be paid by the importer. It takes about 3 to 6 months before the amount is received by the exporter. This time gap affects, this period of time definitely uh, affects the production of the exporter. For this purpose, the exporter will present the bill to the financial institution which provides finance for exporters. The bank can purchase the bill, or collect the bill, or even discount the bill. Post shipment finance is used to pay the wages or other services, and to pay for cargo shipping charges, to pay for advertising in overseas market for promotion. The rate of interest on post shipment post shipment finance varies from minimum 90 days and goes up to 270 days, with maximum 3 to 6 months, and it can be extended based on individual financial institutions. So like I was saying, it depends on the size of the business and the type of the business, or the type of goods that you're selling it to. And it happens, these scenarios arise most of the times. Post shipment finance, this type of finance is seek by the early stage, or a small size businesses, those who are new to this industry. They have just started, they do not know how to uh, arrange funds. And first of all, they are smaller than the importer. The buying company is huge. Buying company is an MNC which do not care whether you have money, you do not have money, and they will have their own style of business. So they say that, see, it is an open market. So open market and other stuff, we will the open account and cash in advance. These things we will discuss in the next slide. So depending on this payment method and the contract, sales contract, you will have to bear the losses of the delay in payments, because importers have told you See, I will pay you only when I receive your goods and sell it to the end user. Then I collect the money, then I will pay it to you. How long it would take? It may take 100 days, it may take 200 days, it may take even year. So in this scenario, you can easily, you know, imagine if you're new to a business, what do you say? You go to an existing player, a buyer, and you tell them, sir, we have a new laptop. This is ABC company. And buyer tell you, I never heard of you. I mean, buyer in the sense the distributor. Then he says, no, you check it out once, give it a try. We are good in this, we are good in that. Compared to the branded laptop companies, our company is giving you this much discount. So the distributor demands you that you can keep your goods here. I don't mind. We can have a contract or whatever, but I will pay you only when I sold your laptops to the end user. That is a customer who wants to use your laptops. So it may take many days. So who's got the advantage here? The distributor, because you're new to the industry. This is what happens. So you have invested all these things. You cannot stop your production. So you need money to run your business, maybe for your capex or opex. So that time you may go out to reach and go out and reach out to the that can be in private institutions, banking institutions. You provide them the invoice billing and the contracts, the sale contracts that you have. Then they do a certain check, investigate, and they see that yes, you have a product which is accepted by the distributors, but you're getting the payments only when the product is sold in the market. So they have understood, at least the distributor knows, when the distributor accepts your products, that means the product has a value. So that until your product creates a traction in the market, until customers talks about your product, until customers come to distributors and retailers ask about your ABC laptop, you have no demand. So you have to agree to the buyer or the importer. So this way, there are banks like Exim Bank I was talking about. These, governed by the country's ministries, they would help you in this case. So post finance is mostly like this. It depends on a product to product. It can be a health product, or it can be goods related to something else. For example, see, if it is a tea products or any health products, you have to have a certification from the health ministry, from a origin of your country. It would put, they would do a back end check and labs. If at all you're selling any chemical products, then you should have a independent lab institution giving you a certification, put a seal on your that the validity is this, expiry date, and all these things. These are the document. This we will talk about in the documentation. So this is the post shipment finance. Like I've told you, you may have to pay to the cargo or shipping people. They do not agree for the credits because you do not know the ship manager, you do not know the shipping company, so you have to pay them. Used to pay the wages of the services that can be the transportation from your uh, state to the port, all these things. Again, to pay for the advertising overseas market, you cannot, like I've told you, you cannot interrupt this delay in payment of your sold products or goods should not interrupt or disrupt your management or operations, anything. This is why. And what they collect is the rate of interest will be higher, the rate of interest will be lowered, varies on the institution, the banking institution that you're going ahead and seeking the finance from. Certain things they would check, like I've told you, the invoice that is being raised, the sale contract you have along with your uh, the importer and the banks in between you, these things would fetch certain value. This will enable you to go for higher credits from the banks or institutions. Yeah. So that's about post shipment finance. Now we have export finance against the collection of bills. This is nothing but the finance or a loan can be obtained by the exporter based on the bills of the purchase made by the importer or overseas company. In the case of any default, the finance company will compensate about 80% of the default amount. It is considered as post shipment finance. Collection of bills is again that I've told you that if you go to a bank and tell them that, see, I have sold goods which is worth of $100 million, I am looking out for $20 million of the finance as, so this is considered as the post shipment finance. So what they, how do they believe the banks or banking institutions, they want to check the documentation, the certifications that you have. The invoice has been raised. Who's the importer? Whether he's, branded in the market. Any bank knows about him, so that if he has a track record of not cheating anybody, uh, not coming into the limelight for the bad reasons. So they would check all these things. That is collection of bills, and again it is considered as post shipment finance. There's nothing else to get confused on this. Like I've told you, finance company can be compensated up to 80%. That is because you already sold. Like I've told you, if you're sold for $100 million, 20% they do not pay you because you never know whether that is a profit or a loss. Looking at all these the bills and verifying it, they would come to know that 80% can be paid. Okay, they'll be remitting banks between your importer and this. They would directly, it would not come to you directly. They would fetch the money once that is being paid. It is like that. That mechanism you will come to know in the latest studies. Do not get confused with it. That's simple. Now we have deferred export finance, which is slightly in between the both cases that we have discussed. It can be initially finance. This finance is also available for the importers, overseas buyers, to facilitate import of goods. There are two types. Supplier finance. Finance is provided to the exporter, example India, by Exporters Bank, Indian Bank, to sell the goods on the installment basis. Then the second case or scenario is, we can take it as buyer's finance. Finance is provided to an overseas buyer by the exporters company. This enables the overseas buyer to pay for equipment or machinery purchased from the exporter company, example Indian Bank. Like we discussed, this is more of the buyer, loans or credit to the importer, the buyer, who is outside our nation, outside our geographical region. Like you in this case, exporter is say a strongest company or a branded company. Importer is a new comer. He doesn't have funds, so it is vice versa. That's why it is called as buyer finance. And the supplier finance is like they discuss, provided to the exporter by the Indian company. Like we've already discussed about it, which is a pre-shipment finance. The buyer finance is to the company which is trying to buy products. Then it is going to be an asset. Again, they will check the product's value in the market, and importers or the buyer's profile, as in the financial status of that company, and if at all he buys the products, how long he would take to sell it off to the end user. All this can be checked by the CAs and their auditors in the bank. Then they put certain charges to this, and they provide this. So this is, as I've told you, deferred. It is not an export or the import. It is in between, that can be given to the importer as well as the exporter. Sometimes exporter himself gives an uh, credit or overdraft sort of a mode, as simple as that. Let's move to the export finance against the allowances and subsidies. In certain situations, if at all there is unexpected rise in expenditure due to national and international changes, or the governments which provide allowances or subsidies for export of goods at the reduced price to the importer. In this case, it is more of a political and the governing bodies inside your country, which is your country, due to this political instability, or governments are changing certain policies. These allowances will give you huge money, because it will be in, you know millions of dollars most of the times. Or even if you're a smaller company, 80% of your product is asset. It is in demand, so it would not you know get staled within weeks or within months. So these things, they always have a track record of all these things, though this is against the allowances and subsidies of your government. For example, if you take China and India, even China and US, because India and Australia, then you have US, mostly Australia, US, and India, they are going really against the Chinese products and goods which are getting shipped from China to these countries. Because the scenario is this, that they're heading to the core, the Chinese products, and there is a wave against. There is a sentiment across people, the nationality. People think that we are Australians. We do not want Chinese, and you know there is a mass appeal. There is feeling. There is sentiment against Chinese products and Chinese government, especially. Not to the Chinese culture or the people. We should understand that this is government. People will come to us, especially the the developed countries. They understand completely. In such a scenario, imagine the companies who are selling their products and goods to other nations. They are going under loss. They are really going under loss. So at this time, China announces has been announcing uh, several schemes, several subsidies, several allowances to them, not to pay any tax, not to do this, do that, and all this. So such a way, product is saying it used to be $100. Now it can be just $60. Reason being is they do not have to pay any taxes. They're getting subsidies in the form of tax deductions. So against this, there will be loans. Your product is still getting sold for $110 and all that, but still you're saving a lot of money. In this case, considering all these things, considering the scenario and taking risk, there are people, there are brokers, there are sellers, the marketing experts. They would buy your product, put a different logo, put a different. They buy it as a raw material. They buy it as a product, just a plain product. Then they would put someone else's company name and sell it off. Not a Chinese company. Then it is like that. Like you take TikTok for example. US has banned it and India has banned it. US has announced before September 50th or 20th. Uh, the President of the US has told the stakeholders, any US company buys it, then it is a US company. Understand? Now people have no feeling. But there are, I mean, why they're hating is because the data is stored in China, and Chinese engineers and the uh, stakeholders are trying to sneak into the other nations' people's data, which is huge, which is really bad. That's why they understand how to sell certain products, how to move certain things in the market, how to rush with your supplies. It'll be easy for them. So that is why. So if at all US company buys it, the data will be stored in US and the data will be stored in India of this particular user's data. This was getting compromised, which is really nasty thing for any nation. It is like that. So this is about the allowances and the subsidies against the finance against these subsidies which a government provides to your company. Then here we discuss about the cash in advance and the open account terms, then the documentary collections. You have letter of credit, which is so popular, LC. These things are known as international payments. Or while you doing a business, let me take that slide, which make it easy for both of us. Yeah, here it is. Here it is. So at the left hand side, if you see, there is the consignment. In the downside, you have cash in advance. Then the most secured is this is exporter importer, the graph. Imagine the exporter is the other side, importer is on the right side. When the exporter is selling products to the importer from India to US or from China to US, imagine that exporter and importer things. If it is an open cash in advance, is exporter asks the importer or the buyer, pay me some money in cash, then I will give you my products. Then it will reach your premises. So importer, imagine importer gives the money to the exporter. Then who is weaker? I mean, risk is to the importer because he is already paid without receiving any goods. And if he doesn't receive, exporter, imagine exporter doesn't give his products, though he has received cash in hand. This is open market, there is nobody in between. So this is risk for the importer. At the same time, exporter comes in the market and exporter and importer do not know each other. Then the importer says, you send me the products, I will receive, I will sell it, then only I will pay you. Exporter agrees. Okay. Goods have been shifted to the importer's port. Importer or the buyer have taken it to his godown. Told the exporters that see we have to sell it, then only we can pay you. Exporter is under risk. Reason being is he doesn't know whether importer sells it off or later comes back and pays it to the seller. Now who is facing the risk? Is exporter. To take out to provide a solution to this, then these modes of payments in the international mode have arisen or took a form. That started with cash in advance or letter of credit, then open account, then documentary collections, then consignment, all this. Now we need to understand what is open account now. These open account terms are nothing but it is an open market. You do not know the buyer, buyer do not know you. So open Open account terms are opposite end of the spectrum. From cash in advance, you as the exporter must finance production with your own available resources and take all the risks that of getting paid. Especially this happens to the exporter. Then, from your client's perspective, this is the preferred method of payment in terms of costs and risks, and it provides very positive marketing sizzle. There are tools that allow you to sell on open account terms without taking all the non payment risk, including a standby letter of credit or credit insurance. This is when you uh, get into the letter of credit that assures you that who will pay you and how to pay you and what is the guarantee that you've given your products to your buyer. Then the existing market or global marketplace standards, if you look at this, global marketplace open account terms are becoming the norm and a competitive necessity for recurring sales, particularly to representatives and distributors that are creating a market for your products. So it is an open market, which is really under risk. This is what the open market or open account says. Then let's go to the documentary collections. So once you decided that we need to have somebody in between, then the documentary collections happen. That you do not know what is there in the package, or a package of goods. So you have documentary that will start with documentary collections, which are a method of payment that actually involves using the banking banking channels for something more than handling the movement of funds. For your payment with a documentary collection, you are relying on the bank to control your product until payment is made. This is accomplished by sending your invoice and bill of lading needed to calm your shipment through the banking channels along with a bank collection letter. Then the second scenario is your bank sends their collection letter with your documents to your client's bank. They contact your client and advise them to come in and make payment so they can release your documents to them. Your most significant risk is your buyer saying they changed their mind and no longer want the product that was shipped. Documentary collection terms can be effective when you wish to have control of your product until it is paid for, and your client does not want to pay for your product until it arrives in port. This can be used effectively for sales to contributors that have the product sold and do not have to offer terms locally. Document collection is less, which has got lesser significance compared to the letter of credit. Like I've told you, when in the open market, buyer and seller are facing the significant risks. All right, which is unpredictable. You never know this guy pays you or not once you given them the goods. So what they have done is they brought somebody into the in between you. So this is letter of credit, or you can call it documentation collection, but still this serves the purpose of how you collect the documentation. See, from buyer to the seller there is one bank. Then from seller to the buyer on the other end, you have two banks. So you will have two nominated banks. Uh, in present days, we call escrow account. So if you would find this in bettings and legal, uh, the cases are in the court. Court creates, there are two parties who say that I have to receive a debt from him and I have to pay credits to him. This sort of cases, a court tells to create one escrow account, which is a third party banking institution or a governed by the government, which says that you reserve your funds over here, then you give all your documents in documentation, uh, no objection sort of certification. So he checks, he sends the duplicate. Once he receives escrow account, he gives the documents to the documentation, the principal one. Then he receives the money and tells that yes, we have received the money that you asked for, or the agreed for the compensation. So both the parties agreed. Then the agreement is done and provided to both of them. It is something like that. Like we discussed in the documentation collection. Like first, exporter provides all the certification. Like I've told you, if at all you're sending or exporting any health related products, what you have to do is you have to collect certifications from origin of country, then the health ministry putting a seal on it saying approved, then ISI mark when it comes to Indian standard products. You have ISI, then so it is government which is providing security, approving it. Yes, these products are approved by the government. Then the health officials. These are the documentation. So bank or documents collection a nominated person. It's maximum. It is a bank. It says that okay, give me the documentation first. He collects, the bank or the institution between the importer and the exporter asks the documentation. Then shipment, which ship which is taking your the goods to the importer's port. So you should have a bill of lading. Bill of lading mostly happens to you when you're exporting goods on sea or through ocean. Okay, bill of lading differs when you're sending. There are articles which is created by ICC or the international regulating bodies, which are ICC and they are the World Trade Organization. These are the two. There are many bodies, but these are the two mainly who are always in the in the mainstream. That is ICC and the World Trade Center, World Trade Organization. So these would check. So you have all the certification from it, and this documentation can be sent to the importer. Importer checks all these things, and he relies on the government's certification. He says, "Yes, I'm agreed." So government, the bank says, "Okay, we need your money. This is the money that you need." Sometimes 50% of it, the agreed amount, or the 100% of it. Maybe once the goods are delivered to his port, then he makes another 50% of it. Or just looking at the documentation, he says 50%. Whatever it is, it differs from scenario to scenario. In this scene, he checks the money which is received, though he will give you a check or whatever the money is received. Bank says to the exporter, "We have received the money that you asked for," and to the importer, the bank says that we have received the documentation that you have asked for. Then done. Then it is gone. So products have reached the importer, money has reached the exporter. All right. So why bank does this thing? Because they charge certain amount. At the same time, like I've told you, there are international regulating bodies of the international, the consumer and all this international market, international business. So these guys would come up and create this. So again, they would charge you certain percentage out of it, but still you're good at it. You are eliminating a lot of risks. which is about letter of credit. Then the so we had discussed about documentary collections. Now let us discuss about the letter of credit. What is it, which is known as popularly known as LC. Everybody know heard about it, and even if you don't hear, generally people talk about LC. So this is about documentary letters of credit or the method of payment where the banks are actively involved in shifting the payment risk and directly settling the payment. Because of this level of involvement, this is the most expensive method of payment for both the exporter and the importer, and it requires the importer to tie up their available credit with their bank. The primary function of a letter of credit is to shift the credit risk of the importer to the issuing bank, and if deemed necessary by the exporter, shift the credit risk and country risk of the issuing bank to a conforming bank. Then thirdly, the payment under a letter of credit is guaranteed by the issuing or conforming bank, provided the exporter can comply with all of the requirements specified in the letter of credit and provide all the required documents in the manner specified. Because of the documentation risk and the costs, letters of credit are best suited to large non repetitive transactions or transactions involving custom designed products. So, like we experience, I mean, the like I've told you earlier, letter of credit is the most expensive, but which is 0% risk. It is a risk-free mode, guaranteed. So you will have to pay certain amount to get this service, and you have to be a prominent a market player. But everybody have LC. Of course, it is not a black market, so you do not have all these things and sell it off. So letter of credit is again two banks. So we as we discussed, I apologize for that. There was certain technical glitch. Payment under a letter of credit is guaranteed by the issuing or confirming bank, provided the exporter can comply with all the requirements specified in the letter of credit and provide all of the required documents in the manner specified. Like it says, they do not, they're very specific, they're very verbatim, and the documentation that uh, they follow, the verification or the interrogation is really international standards. If you have any misspelling of your product or any contract on the sales, they do not accept, and it is irrevocable. Letter of credit is irrevocable. That means you cannot change any term or principle which has been put in your letter of credit. That you need to understand. That means you have your products to the specified or promised level. It has to be, if it is a ABC, it has to be ABC. If it is 1 2 3, then it is 1 2 3. As simple as that. There is no what do you say, no chance or no area to put your dark shades. There is nothing. It has to be white or black. As simple as that. So letter of credit is very prominent. In the letter of credit, you have many line of credit, letter of credit, many things. But letter of credit allows you to, like, the payments that you're seeking, uh, pre-shipment or post-shipment. This would definitely help. So letter of credit is nothing but another party which is coming in between you and the importer. making everything uniform, and they work according to the international regulating bodies. And let's get to the, yeah, this picture. Like I was telling, there are many several terms that you need to get along, like beneficiary, advising bank, then the payment against the application, payment against this, that you just need to, but everything is same. So interconnected. This picture tells you that's the application putting company or exporter, then the who's beneficiary. Sometimes you become beneficiary or other person becomes a applicant. Then issuing bank and the advising bank. It is like that. And these guys consider your branch bank also as a different bank. So according to the international bodies and articles, you have to be very particular about it. Then you have first thing is, you can see this how this letter of credit works. The sale contract first happens between you and the importer or the buyer, because you're a seller. Then the letter of credit application you have to put, then issuing letter of credit you have to take, then the advising letter of credit, then fifth is the shipment, presentation of documents, presentation of documents. I mean, the you provide it to your advising bank, then the issuing bank goes and tells it to the importer. Then document control and payment release, then document release. Like we discussed, this is something like that. Now you must have seen the e-commerce sites, like you have this cash in advance, the paid online. So who is at risk? If you pay online before just looking at the products that you want to buy online, you just paid it. You do not know whether you received the same product or not. The many cases are there. Customers did not realize they have received uh, some toy instead of iPhone. This has happened. So if it is cash in advance, then the you have invested a lot of money in your delivery system and the delivery guy and his company, but cash in advance, believing, relying on the customer's uh, promise, you went to his doorstep. He says that I am not here. You knock the door. You ask the security. The buyer is not there. So you have lost money. Imagine this happens. 30% of your cash in advance are coming back. You as an e-commerce company, you lose a lot of money, isn't it? That's why there are intelligence reports that these companies collect, which can be looking at your social media, then your track record. All right. So all these things matter. This is how it is. So first you put a application, then they see your credit rating. You have SEBI telling whether you have you know running behind your payments or not. All these things would check. Then you will have a track record of your payments, the EMIs. If you have faltered into it, they would put a certain hint to the people like them. It is it. So yeah, these are the banks. Importer will have a different bank and the exporter will have a different bank. Then the exporter will come to know all these things. This is nothing. This system is between the international trading, especially the shipment and export and import. So this was about the export financing and international payments. The coming session, uh, perhaps I would run into the same uh, topics that we've discussed today. We would take these as reference and talk about the ECGC and Exim Bank, and their role in the coming session. And also financing techniques, methods of payments we've already discussed. The credit sources we can put a lighter light on it. Yeah, that's about it. I believe this would give you ample enhancement and sort of running a light on the darker sides. So this is it. We cannot moderate and we cannot go general and give you more examples into it because these are article based, and you cannot run out of the track. You have to be now verbatim. So I had to take my own articles reference. I believe this has helped you to understand about the export financing and international payments, which is under Unit 4. So thank you very much.